current economic situation, of course, is a very difficult one. And there are significant risks to the recovery that we've been seeing since the pandemic. And of course, the geopolitical tensions that are making even worse the situation that we had already. There were already dangers before the war in Ukraine of, a deterioration in the global economy and the results that we had been able to see from globalization in reducing poverty and in, of course, facilitating a more robust growth. And those dangers are because, of course, with more protectionism, pressures for more protectionism, we're likely to see a restriction in international trade that has had good results and impact for the global economy. We're also likely to see tensions and an impact on the international monetary system. We're already seeing, of course, restrictions and sanctions that make for what is becoming a more compartmentalized a system of international payments, restrictions that are impeding financial flows in the way that they existed before. If the situation deteriorates and the war in Ukraine continues for a long time, we can only see a worsening in this situation, and the dangers are therefore clear to us, and the need for the international community to remember what globalization was able to achieve and the importance of multilateralism in getting us those results is very important. One area, of course, that there are clear common objectives, for example, at the level of climate change and the commitments made by authorities at COP26. They certainly need to be taking those forward. And the pressures that this tension in globalization and tensions, geopolitical tensions, make the pressures on, of course, poorer countries are significant and need to be also addressed. The need for more financing, the jeopardization of the situation and the investments in poverty reduction that the world had made over many years. So we certainly are working very hard to make sure we continue to focus on the needs of countries most impacted by the various shocks we've seen in providing the financial assistance that may be some need, the policy advice, of course, and the technical assistance. And it is an opportunity for the world to continue to support international financial institutions in really playing the role that only they can play in making sure that these objectives of common objectives are continue to be worked on and achieved. It depends on how long this unfortunate war goes on. There's a lot of uncertainty that it, of course, creates in Ukraine, of course, first and foremost, but across the world in terms of what the impact on the world economy would be, how inflation will evolve, given the pressures on the additional pressures created by the war and the restrictions on wheat and the implication for food security in a number of countries. It can be significantly worse if the war continues. On the other hand, I mean, there are prospects for, of course, an upside if the war is brought to a speedy resolution. There will be a huge cost of course, trying to working towards the reconstruction of Ukraine, continued provision of humanitarian assistance to refugees. And the impact all of this has had on the global economy, that countries will continue to need support to deal with the most needy countries. But there is, an opportunity to contain the destruction and the impact by bringing the war to a speedy conclusion. The Maghreb, yes. The Maghreb in particular is confronted by several aspects of recent developments that will really weigh on the recovery that we had been seeing in 2021 in the region, and those involve, of course, the potential slowdown in Europe as a result of the impact of the war in Ukraine, the increase in commodity prices that a number of importers of commodities, fuel and food in particular, are experiencing in the region, and the inflationary pressures across the world, the reactions of the monetary authorities needing to contain inflation and address inflation in advanced economies and elsewhere, and the implications that has, of course, for emerging market countries in the region, where we may see some impact on capital flows in response to increased interest rates in advanced economies and the reaction of monetary policies. We also will have been seeing in that connection a more difficult access to financial markets for some emerging market countries. And that's another potential impact for this region as well. On the other hand, of course, there are some oil exporters in the region, and they stand to benefit, and they're benefiting from the increased oil prices. Overall, our projections for the region have been revised downwards, as for many other countries in the world, of course, for 2022, given the pressures that I described earlier. In Morocco's case, it's faced, of course, several shocks, two droughts that it's been responding to, the pandemic, and now the implications of the war in Ukraine in terms of increased prices for commodity imports. In response to that, we've had to revise our previous projections of 3.1% that we had in January when we finalized the Article 4 report to only this 1.1% for this year, in response to the very changed economic situation this year. In response to that, of course, the authorities are doing their very best to navigate this difficult question of working to contain inflationary pressures, at the same time wanting to make sure that the recovery that was underway is given support to be sustained. And so as for other countries, it's a difficult year for policymakers, but Morocco has a very strong record of pursuing policies that are supportive of macroeconomic stability, and we're confident that that will continue. I spoke about the fact that Morocco has demonstrated resilience to a number significant shocks over the course of the past few years, and that comes from, of course, the quick response the authorities were able to put in place, including the rolling out of their vaccination campaign, where now we have 70% of the population that is fully vaccinated. The support on the fiscal side, social safety nets, on the monetary policy and the financial policy, financial sector support that was able to help the economy navigate a very difficult past 2 years. So that resilience has been a very good result of very good policies pursued by the authorities. And Morocco is now, of course, working towards a new model of development, and working not just in defining that new model, but in actually putting in place already a number of actions that demonstrate the road towards achieving a more resilient economy that grows more robustly through the implementation of a number of structural reforms, also around public enterprises, extending the social safety net, education sector reforms, and other reforms that focused on making growth in Morocco more inclusive and more sustainable. So a very, very, very clear way forward that Morocco has laid out, and many efforts underway to reach those objectives. Morocco, as with a number of other countries in the region, and this was a regional study on informality in North Africa, and what factors explain the level, relatively high level of informality in this region. And the study was able to, of course, document that indeed the level of informality is partly explained by the stage of development that countries in North Africa are, and reducing the informality that emanates from that factor requires continuing the process of increasing productivity in their economies, and the reforms that will make productivity, of course, help to mobilize the full potential of the economies, and in that way, the structure of the economy will change to enable a higher share of the formal sector. But there are other aspects that explain the level of informality in Morocco and in other countries in North Africa. They differ from country to country, certainly, but one common factor we found, and also that is important in Morocco's case, is that the quality of governance is also an important explanatory factor, because it weighs on the cost of being in the formal sector, and it provides disincentives to labor market participants or enterprises from wanting to be in the formal sector, and those costs emanate from things like the labor code that make for constraints on part-time work, for example. And different labor force participants, such as women, for example, then choosing to remain in the informal sector, that allows them to work part-time to reconcile the different objectives of wanting a profession and earning an income, but at the same time having family obligations that they want to and need to meet. So the labor code places certain restrictions on part-time work. Other examples, just in terms of the environment, how should I say it, taxation issues, for example, that also disincentivize women also from working in the formal sector, because their income is taxed. The second incomes in households are taxed at a marginally higher rate. So those aspects and other aspects around the transparency of public policy and how tax policies are implemented and how they affect different sectors, the complication of registering to be a business, all of the demands on various businesses to be formal sector employees make it unattractive and costly to be in the formal sector, and measures to address those things in Morocco's case would help to reduce the level of informality. And the report that we've done suggests that with the policies that have been laid out in this new model of development, Morocco certainly has the potential to reduce the levels of informality from the, say, about 30% that we see now to some 20% come 2035. So certainly a clear road of measures that the government can take to reduce the level of informality. Cryptocurrencies, of course, in themselves are neither a good thing nor a bad thing. It depends on how they are managed. They have potential for being very helpful in facilitating cross-border payments, with the technology that they use in addressing issues of use of digital money, making it possible to reduce certain inefficiencies that there are. So potential there, but it is cryptocurrencies are getting to the stage, of course, of being a greater factor in the international monetary sphere, and as they of course align in their changes in cryptocurrencies, and also move in line with other asset prices. There's a risk of some instability that needs to be also acknowledged and worked on. And fiscal cryptocurrencies without appropriate regulatory frameworks in countries can be very risky and to financial stability and to the international monetary system. And that underscores the need for countries and for authorities to look closely at what regulatory policies are important to contain those risks, but to also make sure that those policies are appropriate enough not to disincentivize the positive aspects that can come from use of cryptocurrencies. Having said that, it is important that those regulatory frameworks are consistent across countries, and the international community needs to work towards making sure that the different regulatory measures being put in place are studied closely and are aligned with each other that facilitates continued ease of cross-border payments and underscore the benefits of the international monetary system. It is certainly, of course, understandable that central banks are interested in digital currencies. They have potential benefits that can help with financial inclusion, can help with, I was saying, cross-border payments, can help to improve aspects of the monetary and financial system. So there's certainly that interest is understandable and important to pursue. But it also has to be done in a manner that pays enough attention up front before the move to digital currency, to the issues around how best to contain the potential risks that they are from that, how to design those in ways that are most that can make for success. There are many countries in our membership, I think some 100 countries or so, that are interested in considering looking into digital currencies. Some already having put in place digital currencies, the Bahamas, Nigeria, some looking at the pluses and minuses of doing so, such as Morocco. And with all of these countries, we're seeking to give advice that a careful upstream consideration of the design and looking fully into the pluses and minuses and working to mitigate potential risk is important before putting these digital currencies in place. It does not pay to rush into them, and it pays to be prudent in considering the pluses and minuses. Well, we're certainly in circumstances where our previous, that we expect that inflation is unfortunately going to be with us for longer than previously anticipated. And that, of course, we already saw inflationary pressures just as a result of the recovery underway. Those have been now exacerbated by the impact of the war in Ukraine and the impact on commodity prices across the world, adding to inflationary pressures for many countries. And so central banks are now faced with navigating this very difficult place of working to contain inflation by the actions they take on interest rates or on and other aspects of monetary policy to contain inflation, at the same time as they need to make sure that the recovery continues. And there are many countries that have seen some recovery with very limited employment growth, and so a concern about making sure that employment growth can continue in that context, and an employment-rich recovery is an important concern. So navigating that potential conflict between supporting the economy in ways that make for that and containing inflation are really real and make it a very difficult period for central banks. And on the fiscal side, of course, a number of countries that are highly indebted and at the same time needing to navigate this very difficult period. So inflationary pressures are real and are there, and we expect, though, that come 2023, we'll start to see some containment of inflation, with central banks taking the actions that many of them are already engaging in. We think there's certainly benefits that can come from more flexibility in the exchange rate. It can help countries like Morocco absorb external shocks such as the ones we're facing, and in a way that helps to contain them more easily, and can really act as a shock absorber, the exchange rate. And so we think that there's a good reason to pursue a more flexible exchange rate, and we certainly are working with the authorities towards that end. We've built a very good partnership with Morocco. One that, of course, helps the International Monetary Fund to play its role of giving country-specific advice to our member countries and to Morocco, advice with the view to maintaining macroeconomic stability and to strengthening the basis for more robust and inclusive growth. And Morocco has done very well in that regard, we think. And that relationship has been fueled by what the fund also learns from Morocco as it navigates the different periods that it has dealt with. We've had an important relationship around the precautionary instruments the PLL instruments that Morocco benefited from in the past, where that was facilitated Morocco's access to markets and allowed it to pursue the strategy for reform and development that it had set for itself. Morocco has been very clear about the direction it wants to take, especially now also with the new model of development. Our role is to continue to give that advice that we're reasonably well placed to give, given our experience in other countries across the world, our focus on macroeconomic stability, and the lessons we can bring to Morocco from experiences in other countries. So all of that is part of the advice and the technical assistance we provide Morocco when it feels it is useful, and the countries across the world have to welcome our advice and our support for it to be effective. And in this case, we have seen that very much the case in Morocco, and making for a very productive relationship.
ما تنساش تشترك في القناة وتفعل الجرس باش يوصلك جديد الفيديوهات من هسبريس.